a strategy that we put in place for executive bonus compensation. So when your employer decides to give you a bonus, and that bonus is for, let's say, $100,000, you can take that bonus and you can use that in a strategy like this. We think Kaizen is one of the most exciting benefits in the marketplace today because we've stuck Kaizen or put Kaizen side by side of most of the employee benefits that are being offered and available in the market today, and there's just no comparison to what else is out there. So first and foremost, what's the most valuable asset that employees have? And a lot of employees would tell you that their homes are the largest asset they have. Some employees will say it's their investments account, but the reality is that the most valuable asset that we have is our ability to earn an income. Without our ability to earn an income, we do not have the ability to pay for houses, to pay for cars, to pay for investment portfolios or anything else. And anything that we already own outright, we would end up having to sell just to pay monthly expenses if we lost our jobs or lost our ability to earn an income. And just to prove how valuable that benefit is, let's just take an example of a 45-year-old who's earning $200,000 of salary a year. He doesn't get any raises. He's just going to continue to earn that from 45 to 65. And you'll see that by the time he reaches 65, he will have earned $4 million. Now, if you put that into terms of an employee and what their concerns about, their concerns when it comes to their finances are, we found out that most of their concerns are really about having access to money, not wanting to put it away for fear that they might need it for some medical emergency, and then because they're not putting it away, outliving their retirement savings. Now, all the surveys are pretty similar. This one happens to come from Northwestern Mutual, and the reason I like this particular one is that the reason Northwestern Mutual did this survey to begin with is they were hoping that the clients in this survey would say that one of their top concerns was the death of the primary breadwinner. And in fact, that's one of the ones closer to the bottom. And it's not that most of those employees don't care about their families or don't want to make sure their families are protected. It's just that up against wanting to have access to money and not being able to save enough for retirement and wanting to be able to make sure that they can foresee some type of medical expense due to an illness and outliving savings, it's way down the bottom of the totem pole. And most people, when you talk to them, if you could help them solve these problems here, they're going to give you a lot of their time and attention because this is, out of all the people surveyed, their greatest financial fears. So what we wanted to do was go out into the marketplace and find out, are these legitimate financial fears? Are these legitimate concerns that they have? And we found out that yes, in fact, these are very real concerns. Nearly half of all Americans are one medical emergency away from bankruptcy. Medical problems have contributed to 62% of all personal bankruptcies filed in the United States. So this is a very big concern. Now, if you look at the second thing on that list, it was talking about wanting to have access to money in the event of a medical emergency. What is a medical emergency? Most people don't know. They'll start listing off things that they think, but in reality, we don't really know. Are we going to be affected by some horrible disease, and will that affect my ability to earn a living, or is nothing going to happen to me at all, and I've put all of these protections in place, and I've wasted that money because nothing ever happened to me? The other problem that we have is most of us know somebody that has had some type of cancer. And so that's one of those things that's in the back of our mind on a constant basis. And in fact, if you look at cancer itself, it's the #1 killer in the world. So if you look at in the United States, 1 out of every 2 males will get some form of cancer. This number still just absolutely blows my mind. I just cannot even comprehend that this number is so high. And in fact, 1 out of every 4 men that gets this cancer is going to die from it. And women aren't much better off in the United States. 1 out of every 3 women are going to get some form of cancer, and 1 out of every 5 will die from it. Now, There's a couple of people in my family who've had cancer in my immediate family. And so I don't know why these numbers still blow my mind, but they are just staggering to me. And so this is why so many people are concerned about this. They always hope and think that's not going to happen to me, but in reality, we know so many people that has happened to that it's in the forefront of our mind on a consistent basis and cause for concern. The other problem is we don't know what type of illness it might be. Is it something that's critical? In other words, I can go out and I can have an operation and I'll heal from it and ultimately go back to work? Or is it something that's going to be chronic and I'm going to end up having to live with for the rest of my life and need some kind of assisted care to help me out with those, that particular illness? Or is it something that's terminal and maybe I'm going to deplete my entire savings account, retirement, and everything else just trying to come up with experimental treatment or pay for experimental treatment that's not covered on any of my medical plans? So these are all very, very legitimate concerns. Another legitimate concern is heart disease. A lot of people don't realize that heart disease is actually the #1 cause of death for both men and women in the U.S. So cancer is the world, heart disease is the U.S. But the interesting thing to me about this particular study is that it's claiming over 1 million lives annually, but half of those victims are under the age of 65. So this isn't something that you're concerned about once you retire. This is something that you should be concerned about while you're working. And then you've got the other problem of I've got to make enough money between now and the time I retire to save enough money for me to live another 20 years, and I've got to do that all while I'm trying to avoid all these obstacles of life. In other words, what kind of illnesses might I be affected by? So we all know that the average person retiring is going to have about a 70% chance of needing some type of long-term care. What we didn't know was that 40% of those 13 million people currently receiving long-term care benefits are between the ages of 18 to 64. So now, if that's actually the statistics that I have to worry about, that means I have to worry about this particular long-term care type effect or benefit before I even get to retirement age. And last but not least, 70% of U.S. households surveyed said that they would have trouble meeting everyday living expenses within a few months if the primary wage earner were to pass away. Now, all of those are tied into those top two, wanting to have access to their money in the event that they had some type of medical or financial emergency. However, if that's not your concern, if it has nothing to do with medical, this is the one that nobody can get around. If you talk to any high-income earner, this is the #1 thing that's on their mind. So medical problems is not what's keeping up most of your executives. It's the thought of having to pay more taxes. And that's on the minds of every high-income earner out there in the country today. And the reason that's on everybody's mind is because what happened in 2008 with the financial meltdown, it put in our forefront the debt situation that the United States is in, and we know that there's no way to go out and pay for that debt along with all the other governmental problems without raising taxes. So if we talk about just these two entities, this is the Congressional Budget Office. They were recently asked what the problem was or how we're going to solve the problem of Social Security running out of money. Now, right now, Social Security is due to run out of money by 2022. And Medicare is due to run out of money by 2026. And when the Congressional Budget Office was asked how we solve that problem, they said that they would need to raise every marginal tax bracket along with corporate tax rates by more than double just to shore up these two entities. And that's not even talking about trying to solve the problem of the debt in the United States. That's a whole different number. Most of us know that there's not a politician in the country that's going to allow these two entities to go out, run out of money. Excuse me. And so we know taxes are going up. It's just a matter of when, because any politician that gets elected can't allow this to happen to all the people that are out there that need those benefits. So ultimately, we know we're going to pay the piper at some point, whether we kick the can down the road or whether we try to solve it today. We know that's a problem. Excuse me for coughing. I've got a little bit of a cold, so I'm trying to keep it under control. So the other problem is we're in a situation where we think we don't have enough money or have enough ability to save for retirement. And if you go back to that 45-year-old who earns $200,000 a year, and we look at what he actually takes home, he doesn't take home $4 million like we talked about earlier. After we take into account all the taxes that are paid, if he's in a current 28% tax bracket, that means he's actually only going to get to take home $2.3 million. And it doesn't matter what income amount that you look at. If you earn $300,000 and you were going to earn $6 million, that means you actually took home 3.3. And you can go on and on depending on those incomes. But look at these green boxes up front. This is actually what you got to take home after taxes. This is what you earned. It's really, really staggering when you look at it on a chart. It's almost half of your paycheck. This is why you talk to a lot of executives who earn a good income and they tell you that they're always broke. And the reason that they tell you that is because Fidelity will tell you, and any other financial advisor that's out there, that if you're in a $200,000 income, you need to save at least 30% of that money for you to live in your current lifestyle. Not an extravagant lifestyle, just the way you're living today. So if you think about that, for somebody who makes $200,000, that means that that person that makes $200,000 has to save $60,000 annually, or $1.2 million by the time they get to retirement. So if you think about that, is there anybody you know that's earning $200,000 that's setting aside $60,000 for their retirement? Not really. And if you talk to Fidelity, they'll also tell you that the average person retiring today between the age of 65 to 69 has only saved $136,000 in their 401k. Now, this isn't actually true for the high income earners. This is really what I would consider people that are less than $100,000 of income. And we don't have good numbers on the high income earners. But the reason that this number is lower than what any of us would like that number to be is because most people don't start setting their money aside in their 401k until they're in their late 40s or their early 50s, because if you go back to that number one thing that they said on that list of financial fears, they want access to their money. And people don't like to have to put money into a 401k and then pay a penalty on it to access it before the age of 59 and a half. So most of your younger people are going to put in the minimum amount that they need to put in for the company to match it, but they're not going to max it out until they get into their late 40s, early 50s, and now all of a sudden they're going, wow, I'm getting close to retirement, and I don't have a lot of money saved up in my 401k. However, now you're subject to caps. So you're limited on how much you can put in there, therefore you're limited on your growth, and you don't have the added value of time and compounding. So this is the problem. Half of us want to go out and buy more protection, right? If my ability to earn an income is my most valuable asset, I need to buy as many protections as I can afford to make sure that I'm okay in the event that any of these problems happen to me. And the other half of the people want to say, let's just keep cramming as much money as we can into savings, and next year when I get a bigger bonus, I'll take care of some of those other problems. However, next year never comes. We never set aside the money that we say we're going to set aside. Think about the philosophy, buy term, invest the difference. How many people actually do invest the difference? They buy the term to get the cheaper rate, but they never invest the difference. Why? There just isn't enough money. And there isn't enough money because we're always on to the next thing. Oh, I got my kids going into college, now I have to cover college tuition. Or, oh, my refrigerator broke and we have to spend 10 grand on a new refrigerator. Or whatever the situation is, life happens, and we're in that situation where we never know where that additional money is going to come from. And whatever plans that we commit to, we don't commit to them long term. And the reason we don't commit to them long term is because, back to that, life happens. Some kind of accident just happened, so-and-so just had to have some kind of surgery, whatever those excuses are, and so we end up doing nothing. And we do nothing because we don't know what to do. We don't know where we're going to get the money to cover all of the different types of protections that we need, and we don't know where we're going to get the money to put all this additional money into savings that we need. However, there is a solution. And in fact, the wealthy people have been using this solution for years, since the 1960s. And that solution is leverage. And if you haven't read the book, In the Minds of Millionaires, what you'll find out from that book is what sets us apart from the wealthy people is that in the world of the wealthy, they use every single asset that they own as leverage to get more money to be able to become more wealthy. Why is that? Because they believe that if they were able to go out and borrow money to buy 4 houses instead of 1, the likelihood that they're going to be able to sell those 4 houses at a higher price and get a better rate of return and have less risk because they've spread that risk to 4 investment properties instead of just 1, they believe that that's less risky even if they're borrowing the money from the bank to do it. And in fact, if you think about businesses, Peter Drucker will tell you that businesses are nothing more than other people's money. All businesses use other people's money to go out and run their business. They give those policyholders, bondholders, stockholders a rate of return for allowing them to use their money. So they pay them, let's say 5%, and then they go out and they sell their products and they get a 15% internal rate of return, and then they can pay their bondholders or their stockholders back. And that's the way businesses work, and that's the way the United States works. So why have we not been able to take advantage of that same platform? Well, most of us think of borrowing money from the bank as risk. However, all of us borrow money from the bank to buy our houses, and we don't think about using the bank's money to purchase our houses as risk. We think about it in terms of liquidity. We don't want to tie up $700,000, $800,000, $1 million of our money to purchase a house with cash. So we have no problem going down to the bank and leveraging our assets to borrow that money from the bank to buy a house. So why do we think it's so risky? Well, we don't, because we also use it to buy cars. And in fact, a lot of people out there use it to use as credit cards to buy their big purchases. And also, a lot of people don't realize this, but you could do the same thing on your investment account. If you had a stock portfolio with TD Ameritrade, Smith Barney, any stock portfolio out there, you can apply for a margin loan on that stock portfolio. So why can't we do that same thing to provide ourselves the benefits that we need? Now let's think about that in terms of using a life insurance policy as the leverage to the bank and using a portion of the bank's money to purchase our benefits. So think about it this way. How much would you put into a plan that gave you the life insurance protection and living benefits, and we're going to talk about those, the ability to save additional money for supplemental retirement, and to use that policy itself as the sole collateral for the loan? So you're not applying for a loan, you're not even on the loan, you're just going to give the assignment of the policy itself. Now let's look at the features of those. First and foremost, potential accumulation. So if I have the ability to offer to you a way to supplement your retirement account in an account that provided upside of the market in something like the S&P or the Euro or the Dow, and I took away all market risk, would you be willing to trade on average 80% of the upside of the market for no market losses? And would you like to be able to grow that money tax deferred? And would you like to be able to access that money tax free? And by the way, if I took out about 1% of the cash accumulation that you have in that account, and I use that 1% to purchase death benefit protection, critical illness protection, critical injury protection, chronic illness protection, and terminal illness protection. And I didn't charge you any additional money to provide all these additional benefits. I merely used the death benefit and accelerated that up front. So in other words, I'm paying for the death benefit, but I can use that death benefit today in the event that I have any of these issues while living. And then, if I could figure out how much money I could afford to put in that plan, and I could get the bank to loan me additional dollars. So the way the leveraging works is I'm going to contribute my money, and the bank is going to loan me an equal amount. And I'm going to contribute my money for the next 5 years. At the end of 5 years, I'm going to have enough money in this plan where I do not have to put any more contributions into it. And now the bank has sufficient collateral in there to loan me both premium amounts for another 5 years. So what does that give me? That gives me the ability to put in, as an example, we're going to assume that this executive said, I'd like to contribute $33,000 a year for the next 5 years. So I'm going to contribute $165,000 over a 5-year period of time. And now the bank is going to loan me or match that $165,000 in that same 5-year time period. At the end of 5 years, I'm done. And now the bank is going to make both contributions, mine and the loan in the bank's portion. So that means they're going to contribute $65,000 a year for another 5 years. That means they're going to add an additional $325,000, giving me a total of an additional $490,000 that the bank will allow me to put into my plan and grow alongside my money. Now, I'm going to be able to borrow that money for an additional 5 years, so up to 15 years I'll have use of that leveraged money. That gives me basically a 3-to-1 leverage of my own money that I put into the plan, using the policy as the sole collateral for the loan, and I have a borrowing rate of LIBOR, 1-year LIBOR plus 1.75. So that today is about 3.25 all in. Now if you think about that in context of your car loan, your home loan, even your brokerage loan, that is a very, very inexpensive loan. And don't forget, you're not on this policy, you're not on this loan. You didn't apply for the loan. You didn't fill out any financial paperwork for the loan. You merely put your money into the plan, and then you assign that plan to the bank until you pay off the loan. So at the end of the 15th year, we're going to exit the loan. Excuse me. We're going to pay the bank back their money. And then we're going to continue to let the money that we've earned from the bank's money plus our own money grow until we get to retirement. Just to show you the difference in having that additional leveraged piece, this is an identical plan. This is the same life insurance company. I'm using the same current interest rate, so the interest rates don't matter. We'll talk about that in a second. I'm using everything is identical. The only thing I've done between these two designs is I've added additional money. So if I was going to contribute $165,000 to the National Life Index product, I would be able to strip out $882,000 from age 65 to age 85 of income. And that would leave me death benefits of about $499. And those death benefits are what is driving my living benefits. So I only have access to about $450 $99,000 of death benefits and living benefits. If I'd done, excuse me, if I'd done the Kaizen plan and I had the additional leveraging piece, I would have exited the loan in the 15th year, paid the lender back out of the cash values of the policy, and I would have had $1.5 million from age 65 to age 85 of total income I would have received from that policy, and I would have had death benefit and living benefits of $924,000. And I used the exact same dollar amount that I contributed to the plan. So a lot of people say, what if you didn't get 7%? Okay, if I didn't get 7% using the bank's money, I didn't get 7% using my own money. So if this was 5%, maybe I was only able to get out $500,000, but that means I'm able to get out almost $1 million here. So the crediting doesn't make any difference. The market's going to do what the market's going to do, and you're going to earn what you're going to earn. What makes the difference is having the ability for whatever growth that you're getting to be able to outperform that growth. So now ask yourself this question. If you had one plan that would give you death benefit protection at about 1% of your total accumulated account. So if you think about when you go out and you get into like a 401k, or you have a money manager manage your investments, they charge you fees for being that money manager. So in this example, we're going to have a fee structure that is over a 15-year time period is going to average out to be less than 1% of the accumulated value of what you put into that account. And we're going to use that accumulation money to buy you a death benefit that you can accelerate while you're alive to offer you critical illness, critical injury, chronic illness, terminal illness. It's going to give you, on average, 80% of the upside of the market in return for the zero floor, so no market losses. You can grow that money tax deferred. You can access it tax free. It has features on it that will guarantee a lifetime income if that's what you choose. You can leverage it 3 to 1 at a borrowing rate of LIBOR plus 1.75. You can use that money for up to 15 years as the policy as the sole collateral. No loan docs, no financial underwriting. You're just giving an assignment of the policy itself. You have 5 contributions and you're done. How much would you contribute to that if that was your employee benefit that was being offered to you? Now, this is the end of the employee presentation. And now I'm going to back up and I'm going to show you, if you are just talking to an individual, this is the presentation that you would have given them. And the next thing that you would say to them is, I bet you were thinking this sounds too good to be true. Now I'm going to come back to this in just a second, because if you're talking to an employer that you are trying to solicit to sell to their company, you need to go backwards and talk to them about the employer presentation. And the employer portion of this presentation is very short. So let me just go through that real quick. So, Mr. Employer, why would you want to offer these benefits that we just talked about, these valuable benefits to your employees in the first place? Well, first off, employees are vital to the success of any business out there. And in the United States, the businesses are spending about $124 billion to acquire the top talent. So what they do is they all go out to the schools and they try to find the best of the best, and they're spending about $124 billion to do that. And they're doing that for what reason? They're doing that so that they can bring those employees on, they can get them trained up at their business, and they can keep them there. And they are currently spending 40 to 80% of gross revenues on salaries and benefits. And the typical benefits that people offer are health insurance and 401ks. But most employers know that's not enough to retain those employees. There's nothing that is stopping them from going somewhere else because everybody else is fighting for the same guy with the same exact benefit plan. They all look the same. Employers know that they need to offer better benefits in an environment where cost of benefits are rising. So if anybody knows, the Affordable Care Act doubled employers' premiums on their employees. NIW's cost for each one of our health insurance plans for each one of our employees doubled. And we still have to be able to make a profit and grow our business. And so this is becoming a dilemma. Now, let's look at offering additional benefits and what happens. The typical thing that people do is that they offer bonuses. Why do they offer bonuses? They offer bonuses because when you offer permanent policy, it's a bigger problem, and we're going to talk about that in just a second. But first, let's just talk about the executive bonus. So let's assume that you have a guy that you want a bonus at the end of the year, and whether that bonus is $10,000 or whether that bonus is $100,000, the whole reason for giving that bonus is as a retention play. We want to be able to say to that employee, this is a valuable bonus that we're giving to you, and we want you to stay. Unfortunately, what ends up happening is somebody calls them and says, hey, I've got an employer that wants to offer you an extra $10,000 to go over there. Are you interested? And they go, yep, I get paid my bonus in October. Let's talk then. Now, the other problem is if you offer something permanent that ties them to the company, like a life insurance policy or deferred compensation or whatever those additional benefits are, those are typically used, whether we're talking about deferred comp, with some type of life insurance policy. And what they're doing is they're basically just trying to lock you in. The problem is if you take that same $10,000 that we just talked about from a bonus standpoint and you say, hey, I'm going to pay you a bonus of $10,000 and your employee happens to be 45, you've got to pay that same $20,000 for the next 20 years, and you've just committed your firm to a $200,000 future liability. And the biggest problem with that is multiply that by 100 employees, and you're talking about an incredible amount of additional money. And what's the perception? So if you ask the employees, what do you think about that permanent life insurance that your employer just bought for you? And by the way, guys, most of the time it's not permanent. A lot of times it's just the cheapest policy they can find. But this is the perception. I'm not benefiting from that. How's that an employee benefit? That's an incentive that's supposed to incentivize me to stay here when my kids are going to be the ones that end up with that money, or my wife. And it's not that we don't want to take care of our family, it's that we want our benefits to be benefits, and we want to be rewarded for the work that we're doing at your firm. So if you look at the current benefits package, it looks something like this. 401k, some companies give up to a 6% match, health insurance, and some type of bonus, life insurance, deferred compensation, whatever the additional package is. Most of those, by the way, have gotten taken away. But talk to any employee and ask them what they think about it. And this is typically the opinion you're going to get. So why are we spending all this money as an employer to provide benefits when we get this kind of reaction? And wouldn't you like to be in the situation where you could spend the same amount of money but be able to provide, instead of the bonus, the life insurance, or the deferred comp, be able to provide the strategy that provides death benefit, living benefits, cash accumulation, tax-advantaged growth, and the ability to leverage all of your contributions up by 3 times. This is a much better proposition from an employer standpoint. And an employer is now in a position to be able to say, hey, we offer a benefit package that covers you and your family in the event that you died while you were working here, in the event that you became ill while you were working here. It also helps you supplement your income. I can't afford to give you any more money than I am, but I'm going to allow you the opportunity to put more money into your plan, and I'm going to allow you to put that money into that plan that gives you tax-deferred growth and you can access tax-free. And I've also got features on there that will guarantee you a lifetime income. And yes, I said guarantee, and we can talk about that in a minute. And I'm going to combine that with the leveraging piece to give you access to an additional 75% of your contribution using the policy as the sole collateral for the loan. And I'm doing all of that without impacting the bottom line to your corporation, Mr. Employer, because you're merely making a contribution that you committed to that employee as a bonus or as a deferred comp or as a life insurance premium payment. And you're allowing them to have access to this benefit. So if you were spending the same $10,000, you could put $10,000 into the plan and let the employees contribute any additional portion that they want to contribute, and it didn't cost you any more money than what you're currently doing. Not to mention, you're not on the hook for the loan. You're not signing any loan documents. You're not obligated for the loan in any way, and this policy is portable. So if those employees at some point want to take it with them, you can tie it to a golden handcuff, make additional contributions, and tie it to a vesting schedule. So if you compared this to anything else that they're currently offering as employee benefits, this is just going to blow it out of the water. However, like I said, you need to be able to have your advocate, so make sure you've got the person in the company that's advocating to get this plan in place. I've got a group right now that I'm working on that the person that originally I talked to about the plan wants it for herself, and so she's been taking it up the channel and up the corporate channel, and now it's at the consulting company for the whole group. But it's a 3,000-man company. So you need to make sure that you have an advocate that's going to be stepping right along with you as you're going through these hurdles. Okay, now we're going to talk about how the platform works. So in the event that you made this presentation, the next thing that you're typically going to hear is the too good to be true. That's where we kind of left off. And this is how I answer that question. We need 3 things to make this platform work. It's not too good to be true. This is stuff that has been around forever and ever and ever. It's just nobody's thought about it. The 3 things that we need a participant. So we need somebody willing to make the premium payments. That's either the employer or the employee. We'll talk about that in a second. We need a bank that's willing to allow us to use this life insurance as the asset to leverage. And then we need the policy itself or the asset itself. We're not interested in this asset protection aspect. The bank doesn't want to sit around and wait for you guys to pass away at 100 before they get their money back. So they're only interested in this plan from the cash accumulation. So what you're assigning as the asset is the cash that you're putting into the policy, not the death benefit. That's a very, very important key point. Now, let's talk about the participant. Nobody wants to get in this plan unless they need and want the benefits. So first, if you're talking to an individual employee, it's an employee who wants death benefit, wants living benefits, wants to supplement their retirement, wants to be able to grow the money tax deferred, wants to be able to access it tax-free. I forgot to add in here, wants to eliminate market risk. So they do not want to have any more money invested in the market, and they want to only have to make 5 contributions because I can't keep saving for the rest of my life. Life happens. I got to pay for my kids to go to college. So I have a limited time where I can commit to a dollar amount, and I only want that amount to be 5 years. Now, from an employer perspective, you need to find an employer that is wanting to provide benefits to their employees. So that needs to be something like a buy-sell. I need to put in place a buy-sell agreement, or a key man. I need to cover my key people. I don't want them to leave. That would be detrimental to my business. What about partner buyouts or retention? So I'm using this as a retention play or golden handcuff. And I need to be willing to make the 5 contributions. Sorry, I'm just making a quick no market risk comment note to myself. So the next thing I'm going to need after I've got that in place is I'm going to need to be able to have a bank that's willing to leverage this as an asset. Now, most banks are willing to leverage money for houses, cars, investments, and all kinds of other more risky investments. So why would they not want to do this? Let's look at somebody who would normally go to the bank and they would say, hey, I want to invest in some real estate. And that real estate that I want to invest in is $100,000. So if you bought the house for $100,000, you'd have to wait until you sold that house to see what kind of profit you made. Or you could go down to the bank and you could put $25,000 down on the house, borrow the rest, the other $75,000 from the bank, and now you can get 4 houses. Who wouldn't want to do that? Now, if you use the life insurance policy, what does the life insurance policy provide to the bank that provides more protection than a bank doing this type of investment loan? Principal protection. The life insurance policy cash surrender values all of the money that you put into a life insurance policy goes to an insurance company. Then they take out cost of insurance, and the rest of that money goes into an investment-grade bond portfolio that they hold to maturity. Because they hold it to maturity, there's no mark-to-market risk. They also go out and they buy principal protection. Why? They don't want to take investment risk on their portfolio that they bought a bad bond portfolio, and so they typically go out and they buy or reinsure their investment risk. And that provides an added layer of protection to the bank if they're using it as an asset. They have an assignment on an insurance carrier that's got billions of dollars in these investment-grade bond portfolios, and they have an assignment on the cash, not the claims capability. So think about this. If I give an insurance company $10, they have to go out and they have to put up a percentage of that risk. In other words, if I give them $10, they commit that they're going to pay me $100,000 if I die. So I only have $10 to pay a $100,000 claim. That's why insurance companies are rated the way that they're rated. How much money do they have set aside in reserves to cover those claims? That's not what we're talking about. We're talking about how much cash did they put into their bond portfolio. So if I give you $100, how much of that $100 are you putting into the bond portfolio? Well, if my cost of insurance is $10, $90 is going into the bond portfolio. What is the bank going to now loan me? $90. They're not going to give me the $10 to cover my cost of insurance, but they're going to at least give me $90 of cash that's sitting in the bond portfolio. So this is a very, very credit protected investment as far as the bank is concerned, and it's a lot more protected than margin loans that are market stock loans or real estate loans, which go up and down, or car loans or credit card loans. This is a cash-on-cash loan. Now, we talked about the leverage and how that works, so I'm not going to go through that again. But the point that I'm trying to make to the client in this example is, if I have a cash equivalent to use, so I'm only talking about the excess cash in the policy. I'm not talking about the death benefit. But if I'm using this cash to secure the loan, and in this example, this cash to secure this loan, I've got plenty of cash in that policy to secure the loan, and I don't have to talk to the bank about the death benefit. Now, if the client dies early, obviously the bank loan is going to get paid off, but really more than likely the client's going to live, and so excuse me, we're going to be securing the loan by the cash in the account. So let's now look at how the structure works. The first thing that we have to do, guys, is to make this design work, we have to have the ability for the product, the money that's inside, the cash that's inside that policy, to outperform our cost of borrowing. So what we need to do is we need to make sure that we have very inexpensive borrowing costs. The only way that we can do inexpensive borrowing costs is if we lump a lot of people together. So if I went to the bank and I borrow $5 million from the bank, I'm going to have a lot better terms and conditions than if I go to the bank and borrow $30,000. So first and foremost, we had to set up a structure that would protect the bank so that they cannot lose their money, and also protect the client. And so what we have, every single person that gets into this plan, whether you're one business owner or whether you're an executive that works at a 1,000-man company, everybody has their own trust structure. So let's just assume that you're enrolling a company called ABC Company, and Dave happens to work for that company. Dave is going to set up his own trust. And in Dave's example, he's designated that he's going to make this trust beneficiary his kids. He makes his contribution, or his employer makes his contribution into the trust, and then he waits for us to enroll the rest of his group. Now we're going to enroll Scott. Scott's designated another trust as his beneficiary that he had set up for his family, puts his money in. Paul sets up his and happens to leave his business partner as the beneficiary, contributes his money. Brian puts his trust up and names his wife as the beneficiary, and he funds his trust. Once the whole group is signed up, we're going to pool them together. We're going to add up what the total premium amount is, and now we're going to set up a different trust. The master trust is just a segregator of all of the policies in here. This master trust is now going to go to the bank and say to the bank, I'd like to borrow $5 million. The bank is going to say, where is the collateral for the $5 million? And we're going to say, each one of these individual people inside of this group add up to a total of $5 million. The bank says, great. They approve the loan. They send $5 million of the client's money, so they sweep all these accounts. They send the $5 million to the insurance company along with the $5 million that we just borrowed from the bank. The insurance company now is going to issue each individual's policy back to their individual trust. So each trust has its own life insurance policy in that trust. And now the trustee, we're using a third-party trustee, Provident Trust, they are going to assign the cash of those policies directly to the bank until the loan is paid off. It is the master trust that separates us from these policies and the loan. The master trust is the one that's signing the loan documents. The master trust is the one that has the relationship with the bank. I'm not party to this master trust. I didn't sign any loan documents. I didn't commit any financial personal guarantees other than the assignment of the cash that I put into my plan. So the only thing the bank has recourse on is the cash that you contributed or your employer contributed to your plan. I'm going to say that again, guys, because this is the part of the loan structure that nobody gets. The clients, the employer, anybody that has to do with the plan itself is not on the loan documents. They're not filling out loan documents. They're not going through financial underwriting for the loan. They're not signing personal guarantees. There is no paperwork other than the assignment to assign the cash inside this policy to the bank until they pay back the bank the money. If Dave decides he wants to get out at the end of year one and he had borrowed $50,000, so he contributed $50,000 of his own money, he borrowed $50,000 to the bank. At the end of year one, he can get out, he can pay back the bank the $50,000 plus the interest on that $50,000, and he's back to having his own policy with his own $50,000 contribution, and now his assignment's released and he can take that trust away and give it to somebody else to be the trustee and fund his policy on his own. So when people ask me what the risk of this loan is, the risk of this loan is that you're back to what you were doing in the first place. So if you think about the way you guys are out there selling to your clients, if you say to a client, do you like all the benefits that this policy provides? Yes. Would you like to participate? Yes. How much money can you afford? $50,000. Is that all the money you can afford? Yes. Would you like to cut the time period that we pay into that policy down to 5 years? Yes. Would you like to leverage it up so for all the contributions that you put into the plan, you're going to get 3 times that amount of money at borrowed at LIBOR plus 1.75 pricing? Yes. In a worst case, get out, pay off the loan, and you're back to what you said you could afford. Okay, the company, the trust company we're using is Provident Trust Company, and you guys can go out and look them up online. It's just a third-party trustee. This is not a profit center to NIW. We don't get paid any portion of the trust fees that we have set up. We're basically, we've gone and we've negotiated the cheapest pricing points that we can to have this trust company manage this trust for the next 15 years. You could not do this design without that trust because the bank has to have a bankruptcy remote entity to make sure that if this is the sole collateral that they have for the loan, that they have the ability to make sure that it is bankruptcy remote from your employer going out of business or you or some creditor coming after you. So that's why they need that in a bankruptcy remote entity. Now, the fact that they have to set it up like that to protect the bank also protects you, because that means if your employer, like an Enron, has financial trouble, your policy and your benefits are segregated to your individual trust, and nobody can access those and nobody can get them. We talked about the lending, but why would a lender want to do this? Well, if they'd want to do it for several reasons, and we talked about those. It's a less risky loan than most of their typical investments. They've got the policy cash values that are sitting in a general account bond portfolio. NIW has been doing these types of loans with them since 2000. We've facilitated over $4 billion worth of loans. We have multiple lenders so that in the event that you had another 2008 financial crisis, we funded every single one of our existing plans during the banking crisis, and we wrote as much new business that year as the previous year. We're the only group in the country that can say that. They have committed $1.25 billion to this platform. So we can sell a lot of this before we're going to have to look for more capacity. Now, why is the lender doing this with us? One, because we have an exceptional reputation. Our persistency on our existing $4 billion block of business is 99.63. What does that mean? That means of all the premium finance business that we've put in place on our high net worth platform, 99.63% of the people are still in their plans, and we are 5% plus or minus where we illustrated we were going to be. Now, Kaizen's different. Right now, the persistency on Kaizen is 95%, but the reason that that is a different persistency is because you have a lot more people that have cancer and are using the living benefits and need to pay off the loan. So you're going to have a little bit more turnover in the executive benefit space than you would for a high net worth client. But the point is, why would you ever get out of this design unless you had to access the benefits of the policy, or you lost your job and you couldn't pay for it? Because if you've made 2 premium payments or 3 premium payments, or your employer's made those for you, and you only have 2 to go, and then the bank's going to fund it, why would you want to get out? I would figure out anywhere I could get that money from to pay those 2, and then I'd be done and I wouldn't have to worry about it. So let's talk about the product now. Most people do not understand how these products work. They perceive that these products are tied to the market, and they perceive that these products are actually invested in the market, and they're not. So I'm going to give you a brief explanation of the way that I talk to clients and present this to clients, because if they don't have an understanding of the product, their attorneys or their CPAs perceive this to be very risky, and in fact it's not. So first off, when you give an insurance company premium dollars, what they're going to do with those premium dollars is, as an example, if you put $110 paid $110 to your premium payment, first thing they're going to do is take out cost of insurance. And in this example, I just said cost of insurance was $10, and that $10 is now going to go out, and that's going to buy your life insurance. Now, let's just say that that bought you $100,000 worth of life insurance, and now that $100,000 worth of life insurance you can use as a living benefit in the event that you had any of those critical chronic illnesses or terminal illnesses. This death benefit has nothing to do with the cash value. So you bought this. They have to pay it. If you get into the plan today and you had a problem tomorrow, they have to pay you. If you died, they have to pay your family the $100. If you have a living benefit, they have to allow you to accelerate whatever that living benefit is worth today. However, all the excess cash that you gave that insurance company is going into their general account. What is a general account? Insurance companies go out, and every dollar that you give them, they purchase a bond. And they hold those bonds to maturity. And they buy short-term, medium-term, and long-term bonds. So what ends up happening is you have all of these bonds that have different yields on them and have different time periods on them. And you have this big bucket of all these bonds. And so for every dollar that you stick in there, the insurance company says, currently, my whole portfolio of bonds is paying 5%. And they will give you that as a fixed return. So whatever their current general account is earning, they will give you that fixed yield. And you can keep that fixed yield if that's what you want to do. However, they give you a choice to give up that fixed yield in return for a higher rate of return. How do they do that? They basically say, if I have $5 of interest that I'm going to pay, or yield that I'm going to pay on the $100 of cash that's in that policy, and you want to get an index, we're going to take that 5% and we're going to buy an option. Now, options are nothing more than the right to purchase. So if I bought an option on the S&P, that means that I'm going to spend $5 because I had 5% to buy that option with. I'm going to spend $5 to buy that option. So I'm going to go down to my pricing desk and I'm going to ask how much, if I have $5 to spend today, can I buy of the upside of the S&P? Now, today that $5 will buy you 12% of the upside. However, if I had a 6% interest rate on that $100 and I had $6 to spend, that might buy me 15% of the market. If I had $4 to spend, that might buy me 10% of the upside of the market. So it is this account portfolio that's going to drive how much of the upside of the S&P I can potentially buy. Now, what ends up happening is, at the end of the year, they look at that option and they say, wow, the S&P went down by 20%. And so you're going to let that option expire because it's worthless. You don't want to exercise your option to buy it because it's worth nothing. And so what happened? You lost the 5% interest rate that you would have been credited on the fixed account. You didn't lose your $100, you just lost the 5%. So that means I didn't earn a rate of return, but I still have my $100 in the account. Why? Because when I bought that bond, the insurance company kept the money in that bond, and I had bought principal protection on that bond portfolio, so my money was never at risk. It was only the interest on that bond that was at risk. Now, on the other side, if the market went up, in this example we said that the market went up by 20%, I have an option I want to exercise now, and so I exercise that option and I get my 12% return because I had a cap. So I could only buy 12% of the upside of the market. Now what happens is I had my $100 in the account, I credit the $12 to my account, and now my new account balance, my new principally protected amount of money in that account is $112. I cannot lose the $112. Now what happens? My $112 is protected, and I stick in my second premium. I take out my $10 to buy my cost of insurance, and my beginning balance in year 2 is $212. That's principally protected, and I cannot lose the $212 no matter what happens in the market. Again, I'm going to assume that my yield on the bond portfolio is 5%. It could be 6, it could be 7, it could be 4, it could be 2. But the point is no matter what that yield is, I'm going to take that 5% and I'm going to allow them to purchase an option on the S&P. So again, the S&P in this example goes down. I didn't get any growth at all, but I didn't take any losses either, so I'm at 212. However, if the market went up again, I cap out at 12%, and I credit that to my account, and now my new starting reset principally protected balance is $237. Now, that's your risk. That's your account. That's your money. That's how you invested it in this product. Let's look at that when we add the financing piece. So now I've gone to the lender and I've borrowed $110 from the lender. I have $220 in my account instead of $110. Whether it's my account or whether I've added the financing piece, my cost of insurance is still $10. I'm still buying the same $100,000 with the same living benefits, with the same death benefit. And actually, guys, it creates me to bump it up a little bit. But I'm not going to get into the details of that. I've accounted for it in the loan. So my account balance with my own money is $100. My account balance with the finance money is $210. I have more money with the financing portion to invest because I don't have the same expense drag on the policy as I did with my own money. Both buy life insurance policies, both have living benefits. Both accounts, we're assuming, are in the same exact bond portfolio, earning the same exact 5% today, and I have the ability to buy a option on the S&P at 12%. Market goes down, I credit 0. With my own money, I'm back to $100. With the bank's money, I'm back to $210. If the market goes up, I credit the 12%. I'm at 112 with my money. I'm at 235 with the bank's money. Now, let's look at it after we repay the loan. If I earned nothing at the end of year 1, I would be at $100 with my own money. However, if I borrowed that money from the bank and I got 0 growth, I'd be at $97. So it cost me $3 additional. That's my risk for me to borrow that money from the bank. Let's look at the upside. On the upside, if the market went up by 20% and I capped out at 12, my own money would have given me 112 of the market. But even after I repay the bank their money, get out, I'm at 122 by using the bank's money. This is the power of leveraging. This is why you would want to take on the risk to borrow, because if you believe in index products, and if you believe ultimately that between now and the time you retire that the market is going to have growth, then you have to believe that you'll be able to outperform that money and get a higher rate of return with a lot more leverage in that policy than you could get on your own. And I didn't even leverage this up 3 times. I only put in the dollar from dollar match in 1 year. So imagine as you keep compounding that year after year. And let's look at that. Now, this is an example quickly that kind of shows to the client, look, assuming I've taken out cost of insurance and I've paid that out of my pocket, and I'm only talking about the investment risk, let's apply some numbers to that. If I was in an index, this is why CPAs and attorneys have such trouble with this, because when you say index product, they're thinking index fund. And there's a huge difference between the two. An index product is not invested in the market at all. You're merely buying an option with the interest rate. In the S&P index, you're in an option that's actually in the market. So look what happens to your money. In 2007, the market went up by 4%. So in the IUL, you would have $104. In the S&P fund, you would have had $104. But look what happened in 2008. Remember, we weren't invested in the market, so we're going to remain at the 104 minus our cost of insurance. But if you were in the fund, you're down to $63.44. In 2009, the market had a recovery of 27%. In our product, you were capped at that time. The cap was 12.5. So you would have had 117 minus your cost of insurance versus the $80.57 in the market. And then, of course, in 2010, the market credited 11%. You didn't hit your cap, so either or product earned the 11%, and you credited that to your account. Now, the reason this is important is because it's not so important about the caps or how much of the upside of the market that you can capture, is it is missing these negatives. Now, if you really understand how this product works and you have the ability to go up and up and up, and you cover your cost of insurance, all the excess money you're putting into that policy is going to get growth. So let's talk about cost of insurance, because so many people say, oh, life insurance is too expensive for you to fund in this way, and your costs are going to eat up all your accumulation. Well, that's not true if you design them a specific way. The way we've designed this product is we have done spread comp, we have reduced fees and expenses, and we have put in the maximum amount that we can put in before the government will tax it as an investment. And we go right below that amount, and then we consistently put that amount in each and every year. Now, because the government has limits on how much we can put into this versus how much insurance we can buy, what happens is, even if we strip this policy down, we're still going to have a 16% cost on this product in year one. But look what happens in year two if you consistently overfund it to the max amounts. It goes to 8, and then it drops to 5, and then it drops to 3, and then 2, and then it's so minuscule, it's like a blip. Let me show you something. This is the cash, the excess cash that you're putting into the policy. If you consistently overfund in the way that we've developed and designed this product, your fees, expenses, cost, and everything are less than 33 basis points. Now, the reason it says 88 is because we added cost of the borrowing. So even with your borrowing cost and your fees and expenses, if you consistently overfund it, your costs over a 15-year time period are going to be less than 88 basis points. Think about that in terms of what you pay a money manager or what your fees are on any of your stock portfolios. And by the way, that 88 basis points buys the death benefit, the living benefits, all of your coverage. Now, a lot of people say to me, oh, buying term and investing the difference is cheaper. So let's look at that. It's true that term is inexpensive from 45 to 65. In fact, for 45-year-old executive standard health, this policy is about $37.37 for 15 years. Now, we did this as a 30-year term. So we're going to pay that $37.37 actually for the next 30 years, and so until age 75. And at age 75, it's going to go away, or you can convert it. If you convert it and you buy another 40-year policy or 30-year, whatever that time frame is, that premium jumps to $38,000. And if you held that to normal life expectancy, all we did was calculate what it would cost you if you passed away and you're paying your premium every single year to age 85. That cheap, inexpensive term just cost you $693,000, and we didn't even calculate the additional money that you were supposed to set aside. Now, a lot of people go, well, I wouldn't do that. I'd go out and I'd buy a permanent policy. And whether that permanent policy is a whole life, guaranteed universal life, doesn't make any difference. If you went out and you bought the Lincoln level term product and you held that policy to age 85 and paid the premiums at age 85 and then passed away at age 85, you would have spent $390,000 for that inexpensive. And by the way, this is $1 million of death benefit. Now, a lot of you guys would say, I sell index products, and so I would get my client to max fund these products. Well, a lot of you guys talk about doing that, but the problem is most of your clients can't afford to max fund them. And in order for a client to max fund these policies on a consistent basis, they would have to contribute $350,000 over a 10-year period of time. So for the next 10 years, they're going to have to cram $350,000 into the plan to get the $1 million of death benefit. Or we can use the exact same policy, the exact same index universal life policy, and contribute $165,000. So if you're looking at cost of insurance only, we're not talking about cash accumulation at all, we're just talking about cost of insurance, which one of these are you going to do? Now, when you add the added features of additional death benefit and additional accumulation and additional benefits, look at the difference. Your own money, $33,000 a year. Adding the finance, you're contributing $70,000. That's going to give you death benefit of $499 versus $924. That's going to give you a total annual income for from 65 to 85 of $42,000 a year versus $75,000 a year, totaling your benefits of $882 versus $1.5 million. This is a, really guys, this is a no-brainer. It's why would you not use the money that you can get by merely leveraging, excuse me, by merely leveraging your own contributions? This is exactly the reason why we tell you that this is the best benefit on the street, bar none. And anytime that you're uncomfortable with this, you can get out. Now I'm going to do one more thing, guys. I'm going to go through the stress test. And what I'm going to tell you about the stress test, guys, is no matter how worried your client is about their contribution, their $30,000 or their whatever, the bank is a lot more worried about that money than they are. Why? Because the bank is using this policy as the sole collateral to get repaid. So they have to feel very comfortable that not only is it bankruptcy remote, but that it has a high probability of having enough cash in there for them to be able to get repaid. And so they don't care about the illustrations that you guys run. And in fact, the illustrations that you guys typically run are meaningless when it comes to financing. Now, if you want to show illustrations to your clients with a 6% rate of return or 5% rate of return, have at it. But it's meaningless when you're talking about financing, and the reason is if I show over a 20-year period of time an illustration, the insurance company is forcing me to use their look back. And it is whatever it is. So if I take today's bond yield and I look back over the last 20 years and I can only capture 12% of the market, what would I have credited to the account? That gives you your current illustrated rate. And in fact, it irritates me when agents say to me, that's not realistic. That means to me you don't understand this program, because we're in the lowest interest rate environment we've ever been in. Your bond rates of return cannot go any lower. Well, they could, but they are at the lowest they could be. And if we can get 12% of the market, and you applied that 12% to the growth of the S&P over the last 12 years, my historical rate of return would have been 6.63 over the last 15 years. So who cares? If it's your money, it's going to earn 6, it's going to earn 12, it's going to earn 2. What difference does it make? But when I apply the bank money, the bank is making me use forward projections. So they're going to give me a LIBOR forecast for the next 15 years. They're going to tell me what the banking financial community thinks interest rates are going to be today and for the next 15 years. And they're going to give me that plot, and I'm going to add the 1.75 to it, and I'm going to show you what that design looks like. However, that's not the whole picture to them. They want to know, hey, you're not going to pledge more money. You don't have personal guarantees. So what happens if we have a Great Depression and this product earns zeros for the next 5 years in a row? And let's look at that. Excuse me. Here's the S&P, negative 28, negative 47, negative 15. If you were in this product, here was the insurance company's actuaries. And what they did was they went back to the 1930 time period, and they said, if we had bought the options, and in fact, there's a few companies that can do this, like National Life, because they were around back then. But any actuary can figure out what the current portfolio of bonds was yielding at the time, and then they can find out what the volatility was of the S&P, what the prices of the options would have been, and they could calculate what they would have earned in that product. And so these aren't our numbers. These come from the insurance companies that we work with. Their actuaries put these together. But what that means is I got into this and I borrowed money, and I've gotten no credit on that money every single year. But look at my loan pricing. There was no LIBOR back then, so HSBC gave us the New York Fed rate, and it was 4%. But when I add my 1.75, it actually cost me 5.75 to borrow that money, and then 4.75, and then 3.75, and so on. This looks a lot like what happened, like what we just went through, right? From 2000 to today, interest rates were higher, and then they started to drop, because what happens when the economy's in trouble? The government goes in and they lower interest rates so that it will increase spending and try to spur the economy back to health. However, 1935, the insurance company tells us what they would have credited at the time was 33%. When we did the spreadsheet, the current cap, today's cap rate was at 13. And so that would have been if you had a current cap rate at the time period. But these numbers don't matter. What really matters is the actuaries tell us this is how much they would have captured of that particular product, 7.2. If you had today's bond portfolio, you captured about 5. But you had 3.3% borrowing costs. And so were you able to outperform the money that you borrowed? Yes, you were. Whether you had current cap or today's cap, and here's your borrowing. Here's your borrowing here. So all we're looking for is we're looking for a spread. And all we're illustrating for at NIW is a 2% spread. Well, I had better than a 2% spread whether I was using today's bond pricing or whether I was using the actual bond pricing of the time, or what the insurance companies estimated was the actual pricing of the time. Now let's look at, oops, I skipped one, sorry. Let's look at the 1980s. Same chart, but the 1980s. And look what happened here. Interest rates were at 13.13 at the 1.75, and look at my borrowing rates. People always ask you on these deals, what happens if interest rates go up? And we've modeled to that. So if interest rates go up, what typically happens to your portfolio? You have more money to buy more options. So look at the actual caps of the time period. You had a 26% cap in 1980 and a 15%, 17, and so on. And so the actual rate of return of the product was 13.25 with a borrowing cost of 10.05. Now, even if you had today's bond portfolio, which couldn't happen, and the reason this couldn't happen is because you would have just flicked over to the fixed account. If your borrowing cost is at 14, what's your fixed account earning? So this is kind of silly, but we do it to be compliant. Still, ultimately, this would have recovered if you kept it in there for over 15 years. And by the way, that's one of the things that we would have done is we would have said we need more time to work out these averages. But in fact, we had a 3% spread. Now, here's why the attorneys and the CPAs always ask you to run a lower rate of return, because in their mind they go, hey, if you bought an option on the S&P and you bought that from 1930 to 2014 and you take off dividends and you take off reinvestment because you're not actually in the S&P, that would have given you an average rate of return of 6.33. The products have caps on them, so I want you to run your illustration at something lower than 6.33. Now here's why they're wrong. We don't have to average in these losses using an index product. And by taking out those lost years and inserting a zero, that changes your average to 11.67 versus 6.33. Now take off the on average 80% because of our caps, and that gives you an average of 9.3. But who cares again? If it's 9.3 or 10.3 or 12.3, all I care about is if I borrowed money. If I borrowed money, what did I borrow money at? I borrowed at 6.35. Now this is my favorite chart because this one is, everybody has these numbers. We've been around this long. We know what our borrowing costs are. We know what our credits to our policy were. And so that's why this is my favorite chart, because no spreadsheet, no illustration, no other agent can compete with real numbers. Now, just so you know, here's the real numbers. In 2000, here's the S&P. -10, -13, -23, and then we had 26%, and so on. This is if you had a current cap, 6.13. This is the actual cap, 6.63. And look at my borrowing, 4.23. Now, what a lot of people don't get, look at what rates were in 2000, 6.85. 3.73, 2.1. Why did this happen? The market went down. What did the government do? They went in and lowered interest rates. Then what happened? The market started to recover again. Interest rates were at 5 and 5. And then what happened? The 2008 financial crisis. And look what happened to interest rates. And look where we are today. So my average borrowing cost was 4.23 with an average product return of 6.63. What did I say we needed in these designs, and what have we modeled to? A 2% spread. And even if you use today's cap, we're at 6.13. Even if you use a 12% cap, well, we did use 12, sorry. So even using the 12% cap of today, the product would have earned 6.13. In actuality, it earned 6.63. We have some clients that are averaging much better than that. But as I said again, because of this average borrowing cost, we're averaging 5% plus or minus where we said to our clients we were going to average. If you look at my own policy, I've been in my plan. I was the very first group in the Kaizen tranche. I got 13 in year 1 because the caps were 13 a couple years ago. my borrowing cost is 2.75. Year 2, I got 7.58. My borrowing cost was 2.75. Year 3, I got 0. My borrowing cost was 2.75. My 3-year average on the product credits is 6.88, and my borrowing cost average is 2.75. Real numbers don't lie. And that's what I love about this particular chart, because when people go, well, you don't have all the upside of the market, here's the cap. So it didn't matter so much that we didn't get all of the upside, because the black line is the upside of the S&P, the green line is our caps. What really made the difference is not taking the 0 out of these 5 years. And that completely changes your rates of return. Now, we measure option efficiency. So remember when I told you the products that we were looking for gave you on average 80% of the upside of the market? It's actually 86 when you measure it. We round it down to 80% to be conservative, but you can tell there is nothing like this on the street for the risk reward, for the ability to leverage, for the vehicle itself to get the kind of benefits and tax advantages. You can't find anything out there that can compete to this. All right. Thank you guys so much for staying with this long presentation. So for those of you that want to remain on and ask questions, what you need to do is raise your hand. I'll answer your questions. For those of you who want to exit, have a fantastic weekend, and thanks for sticking with us. Daryl? Daryl Long? Daryl, you're self-muted. At least it says on my screen that you're self-muted. Are you there, Daryl? Okay, I'm going to give you a second to see if you can unmute yourself, Daryl, because I can't. I don't have the ability if you've self-muted yourself. I'm not sure if I'm saying this right. Is it Kawizi?
Yes.
Hi, how are you?
Not bad. Now, I wanted to find out, okay, what is the compensation on stuff like that, doing this? And
okay, so first and foremost, this product was not designed to be sold individually. So I'm going to tell you that right up front, because this was designed to be sold as a group plan on the executive space. So it acts more like a COLI type product, if you're familiar with that. It's spread comp. So you end up actually getting paid more, even with our split. Our split on this plan is 30%, but you end up getting paid more than you would have been had you been paid up front, because we're adding all that extra leverage money to it. So you actually make more, but you have to spread that out over a 5-year period of time. And then the reason that you also make more is because you're spreading it. If you were going to earn $100 as an example, you're going to earn $120 because they're paying you more to spread it. So you earn more because of the leveraging piece, and you earn more because of the spread comp, but you get it spread out over 5 years. So what I say to a lot of agents is, look, what this has helped me do is it's helped me get into a lot more companies. It's helped me sign up a lot more individuals, because if I was out talking to a CPA or attorney or even a client to get them to help me present it to the company, everybody that I present this to wants in. I do not, the only way that somebody's not going to want on this plan is if they don't have the money. So if they don't have the money, they're even more incentivized to get their employer on to help pay for some of these expenses, because who wouldn't want this type of plan as an employee benefit when you think about what you currently have available to you? And so what's happened to me is all those people over the last 3 years have said, I don't want to wait on my employer to make a decision, so can I get in? And then they went and told their friends, and then their friends called and asked if they could get in. And so I've ended up selling a lot of individual policies. So what ended up happening to us is we started doing those, what we call tranches. That's what you see on the website. So if you have a group, and your group is big enough to do this on their own, You just go out, you do the enrollment, and as soon as you're done, you enroll them, and we fund the plan. The ones that you see on the website, those are from people like me that have sold these to a lot of individuals. And I don't know how many I'm going to sell in a month. And so I don't want to have to worry about coming up with, 50 of my own people before I can actually fund my people. And so I'm pooling them all together from all the agents across the United States that are selling this, and I'm sweeping those accounts every quarter. So
Okay.
I know as an agent, if I've got a client that wants to get in this plan, as long as I get them through underwriting and up, and their trust set up and then funded, I know that I've got my deadlines. The next deadline coming up is February. So I know I've got to get all my clients, the applications, through underwriting, paperwork, funds committed into the trust, funded. You're not funding your premium, you're funding your own trust. It's a money market account, and that's the account we're going to sweep from. And I know if I can get all that done, all my clients that wanted to participate can participate by February. So that gives me some time to go out and get the equivalent of a group.
Okay, and how many, so it doesn't mean that we have to go and put together the group because they're going into your group.
That's correct.
It can be done for individuals.
Yeah, you can do it for individuals. You can sell it to individuals. You just add them into the group with everybody else.
Okay. All right.
Makes sense? So you don't have to worry about it. And the thing I like about it is, my philosophy on it was, hey, look, and I'm kind of the one that started that with the firm here because I was going out and calling on all these people that were saying, can I participate? And I thought, I'm there. I'm here because I'm prospecting, and I'm trying to get them to introduce me to some of their companies, or I'm talking to the employer, and if they want in, I should be able to go ahead and just get them in and get paid for it. Even though, it's only one individual sale, why shouldn't I get paid for it? And so that's why we started doing these, what we call tranches or groups, and grouping them together.
Okay. All right. Thanks. And how can I get in touch with you?
Somewhere there's a slide. Let me find the slide. Hang on. While we're going through the questions, I should probably just have the website up, but there's a slide on here somewhere that's got our phone number. I know it's in here. This PowerPoint's pretty long. Wow, this is a really long PowerPoint. I'll find it in just a second, and I'll put it up. Here we go. All right. That's how you can reach us. All right, have a great weekend. Let me get to some of these other questions. Bob, are you there?
Yes, good morning.
Good morning. Well, I'm sure it's warmer there than it is here.
Fantastic presentation today. Just wonderful. Really, really sets it off for us. The question I have is I just want confirmation. The presentation, the presentation that you just went through, each of the so-called platforms, that's identical to what is available to us as we click on these platforms, correct?
Yes. Yeah, that's on the website. So, hang on just a second. Let me show you. It's right here.
Yes.
See where it says Kaizen Complete?
Yes.
That's the whole thing that I just did.
Okay, so the complete one will include all of these.
Correct. And this is broken down. So look underneath it. So see where it says if the above file is too large, you can download them in segments. So employer, employee, trust, insurance product, too good to be true, target market, qualifications, next steps, and stress test.
And the stress test. Very good.
And what I do with a client is I don't like to use illustrations. I basically say to a client, if you had a benefit that looked like this and had all these features available, how much would you contribute? And I make them tell me an amount.
Yes.
And then I go in and I say, if they're a male 45, I'll use the illustration to see if they qualify. So if they told me 30 years old, and I want to go on to, oh, something's wrong with these. If they told me 30 years old, I want to go on here and I want to find out if each illustration, I'll look up each illustration. And by the way, these illustrations are supposed to be drop down, so I need to go find out what's wrong with it. But it drops down to the illustrations at each age, and it may be us uploading new ones. So if you don't see the individual illustrations in here, it's because we're uploading new ones.
Good.
So
Okay.
what I use the site for is I go in and I look up their age, I'll pull up their illustration, and if it says the minimum for a 45-year-old is 30,000, and they told me they wanted to put in 50, I go, great, you qualify, now let's go through underwriting.
Gotcha.
Because once they go through underwriting, then you're going to know what their underwriting offer is, and then you're going to give them a real illustration based on their underwriting offer and their actual amount that they've agreed to contribute.
Very good.
You know, the credits and all that stuff don't matter. The market's going to do what the market's going to do, so why do you want to give them assumptions that aren't realistic? One thing I know for sure, that product is probably never going to hit the 6.83% that you're illustrating as a look back because it's all over the place. It might average that, but it's not going to consistently hit that, and that's why I don't like to use illustrations. But
right.
Anyway, it's all there. It's all there available for you, and I just get them to give me an amount, and then I use that to show them as a sample, and then get them through underwriting, and then I give them the actual illustration, and I tell them to completely ignore it because I said next year it's going to be totally wrong. But you guys sell however you want to sell.
Yeah. Very now, and again, it really revolves around the total closing question that we always use. Let's see how your exam comes out. Now, I've got a question. As we went down through, and it was at the bottom of the Provident Trust group, there were 5 questions that you made, which are really the closing questions. Starts with, do you like the plan? Could you give me those 5? I couldn't write them fast enough.
The questions I ask the client?
Yes.
Okay, what I typically do, let me find it. It's really hard to find stuff when you got the whole thing open.
Yes, that's true. I appreciate this. I think those questions are critical.
This is actually, I'm not sure if this is what you're talking about. This is actually what I go through with the client. I basically say, if you have a platform that looks like this, how much would you contribute? Oh, I know what you're talking about. You're talking about this one. We only need 3 things. Hang on.
Yeah. Do you like the plan? How much would you contribute? And then there are 3 or 4 more thoughts that you had. Actually, the closing questions.
That was the one I was just on just a second ago. That was the one I basically say, if you had a plan that looked like this, that provided death benefit, critical illness, that one.
No, I got that covered. There are 5 questions at the conclusion. It was right after you made the presentation of the Master Trust and the Provident Trust Group, and then you said, in closing, Mr. Employer, do you like the plan, etc.?
I don't know.
Okay, all right.
We'll take that offline and let me see if I can. It may be something I said that's not on the slide. I just said it because some of the things I say when I. So let me think about it and I'll go back to it. Or I've got it recorded so we can go back and re-listen. You can fast forward to it.
I think that's exactly it. It was questions that you asked that was not on the that was not on a slide. There's personal questions that you ask at the conclusion.
Well, thanks to my Alzheimer's, I record them now. So
very good.
We should be able to go back and figure it out.
I'll give you a call later.
All right. Thanks, Bob. Have a great weekend.
Thank you.
Okay, let's see. Who else? Daryl, were you able to unmute yourself? There you go, Daryl.
This is Daryl, 145. I'm a little bit
Daryl?
late. Two emails that you sent me. I'm going to review them over.
Okay, he's busy doing something else. Mary Bo?
Hi. Thank you, Helen,
Hello.
for a wonderful. Hi, Helen. Thank you so much for a wonderful presentation. I appreciate it so much.
Thank you, guys. By the way, Mary, let me interrupt real quick. This is not Helen. It's Grace Barnard, and I forgot to change the dashboard to say who is presenting. So anyway, go ahead with your question.
So you're Grace.
I'm Grace Barnard.
Okay, thank you. Yeah, because I seen that on the viewing is Helen Bodine, so I don't know.
I know. I always forget to go in and change that, but anyway, doesn't matter.
Okay.
How
well,
can I help you?
I was about to call you, but since you are here, I mean Grace. So I have you know, on the application when I fill out for the insured. So the insured is not the owner for the first 15 years, correct?
They're never the owner because they're putting it into their trust, but the trust is, right? The owner is the trust. So as in an example, my trust says Grace Barnard. My trust is called the Grace Barnard Trust for the benefit of, and then I have my daughter as the beneficiary.
Okay, so you can, where is it about to write your beneficiaries' kids or destiny to your daughters or your children? Where is it on the application? You write that down.
You write it on the trust document. So because the trust, yeah, the trust is the owner, and on the trust document you're going to put on that document that you know, your daughter is the beneficiary, or your husband, or your business partner, or whoever that is. And so what ends up happening is the death benefit gets paid to the trust, and then the beneficiary of the trust is, in this example, my daughter, and so the trust would turn around and issue all that money to my daughter, and it grows tax-free. So, so the trustee is nothing more than a person who monitors, you know, the account each and every year. And if you're not in this plan anymore, you still have your trust. You filed that trust with the state. So you don't have to have Provident Trust as the trustee. You may have your husband or your sister or your attorney or your CPA or somebody, but it's, or you could dissolve the trust and just have the policy if you choose, but you've already set it up, you've already paid for it, so there's no reason to do that.
Okay, yeah. So it's gonna be the insured insurance trust, and then you know, on the formal application, I don't know where it doesn't list for destination of the beneficiary.
Okay,
who
so if you go into the
I have the form here with me, but it's just an individual life insurance application that I'm talking about.
yeah, but on the, let me show you
how to fill out the form on that
there's
form.
a thing on here. There's a thing on here that shows you how to fill out the forms. Now, when it's not listed on here, the reason it's gone is because every single time that we do a group enrollment, as soon as that group is done, we pull all the forms off the website, and then we upload them with the new ones for the next tranche. So we just finished funding the last one, and so those were pulled, and now we're starting the new one. But you can look in here, and you can go to each one of these, and you can open them up, and it shows you how to fill it all out. This is the informal application. This is all you have to have filled out until you're ready to pick up your checks and until you have your underwriting offer. There's 5 forms that have to be filled out.
Right.
Here's the tutorial. Okay, so here's the tutorial.
Can you go to the formal application? That's where I am right now.
I can't. I can only go in here. See,
Okay.
this is the formal.
Yeah, can you go to the next part?
Which part?
The trust, the beneficiary information.
You know what you need to do? Oh, here it is. All right.
By the way, where can you print this out from?
Yeah, this is on the website. I just showed you on the website where it is. And it has everything in here. It's got all the, see, here's the beneficiary information right here on page 6.
Okay. Page 8. Page 6.
Oh, yeah, sorry, page 8. So, yeah, you just go, we've made everything on here so that it's walking you through every single thing. And we've shown you how to fill it out. We've shown you how to read it. We've shown you where you need to have signatures. We've shown you where you need to order the medical exams. We've even showed you how to fill out the application. If you follow this tutorial, you cannot mess it up.
Okay.
See, this is the important one because you want to make sure that you're filling it out correctly and that you're having the client sign in the right place. So we've even shown you examples and everything.
Okay. Another question is, can we mail the check out by priority mail, or it has to be overnight?
You can mail it out as long as it gets here before the deadline. So each tranche date is going to have a deadline. Let's see what
So for this tranche, it will be deadline calendar is February something, right?
Yeah. That's not what I'm looking for. I'm looking for the tranche. Oh,
Yeah,
it's on there.
tranche deadline right there. Yeah.
That was the one we just had. I need to go to February. There we go.
I think the 16th?
17th.
The 17th. Okay.
So as long as everybody has all their stuff in by the 17th and it's funded, et cetera, then, you know, it doesn't matter how you send it. Because they're not paying us and they're not paying their premiums. They're just funding their own money market account. So they need to have the trust set up, and they need to have written their checks, and they need to have, you know, their money, they need to, you know, gotten their money deposited and the checks have cleared, because it's those money market accounts that the bank is going to go and look at for this, right? They want to know that the money's there before they fund it. So if you go back to the master trust here, sorry, I went back too far. The master trust, when we go to borrow the money, they're going to look at each one of those accounts to figure out if I'm borrowing $5 million, is all of these accounts add up to $5 million.
Okay.
So if their trust isn't set up and their trust doesn't have the money in it, then the bank isn't going to, they'll kick them out. And then they'll just have to wait till the next tranche.
Right. Okay. So there's no hurry to turn it in the overnight.
No, there's not really any hurry until you get closer to that tranche deadline. But you don't want to miss it. So, you know, a lot of people go to collect checks from clients, and then the clients don't have it. If you're like me, I want to write the check. If I'm getting paid my bonus, I'm writing my check right now for my Kaizen, even if they don't take it until February, or even if they don't take it until June, because I don't trust myself not to spend that money. But but that's me. Some clients, you know, have no problem with it. To me, out of sight, out of mind.
That's right. Yep. Okay.
Thank you. Have a good weekend. Okay, let's see. If there's anybody else? Last chance. I'm getting ready to hang up. Han? Han?
Hi, Helen. Grace, I'm sorry. I just have a quick question. Can I get access to the recording of this presentation? Because you said something in there great that I couldn't write it down fast enough.
Yeah, no problem. I'm going to record it, and I've already recorded it, so I'll get it up on the website, and you'll be able to just go click that button on the website. Where's that button? Down here. You see that button next to the IN? So you'll be able to click that, and let's see what's up there. See all these webinars here?
Oh wow. Okay. Awesome.
So there's lots and lots of them, and I'll add today's on there as well. These are a lot of duplications too. So, and then there's some other stuff from our university.
Yes. Awesome. Yes. Thank you. Well, you have a great weekend.
You
Thank
too.
you.
Okay, anybody else? I still see Daryl's hand up. Hang on just a second. I'm going to go back. Daryl, are you there?
Can you hear me?
I can hear you.
Hi, Grace. How are you?
I'm good. How are you?
Well, my only question was about recorded, whether you recorded when it would be posted. So you already answered that question, I think.
Yeah, I have to. It takes time for me to download it from the GoToWebinar site, but it'll probably get posted between now and Monday.
Okay, what's the website title, the address of the website?
Oh, www.kaizenplan, so it's KAIZENPLAN.com.
Yeah, I think you changed it from the last time. And then the last question is about the tranche dates. Edgar and I talked, and he told me, a month or so ago it was March. You're saying it's now February. Are these done on a sort of a predictable basis, or just when you have enough? Or how do you do that?
No. So once we collect all of the people that are in the group, the bank has to look at each one of those accounts to see that the money's there. So if we're going to fund in March, we need to have all the money in the trust account by February to give them a month to go through each one of those individual little accounts. So we're going to fund, March, June, September, and then the last one in December. That's the one we just closed. That's the one we're working to fund right now. So the fund date for that one is, I think, December 20th is the date we're going for, but it'll be funded before the end of the year. However, the deadline for that group was in November.
Okay, so you're telling me that the funding is really like March 17th, but the paperwork deadline is February 17th.
Correct.
Okay. That's good.
It's really funny because a lot of agents always say, why don't you fund these quicker? And I'm like, have you ever done a group enrollment? I mean, by the time that you get all the applications, the medical underwriting for a large number of people like that, and then you have to open up each individual account, and then the bank's got to look at it to make sure that all the money's there, and then they've got to wire the money to the insurance company, and then the insurance company's got to issue those. I mean, it's a huge process. So
it's enormous. Absolutely,
yeah.
It's enormous. It's a big job.
It is, absolutely. And so we're funding them as quick as agents can get paperwork to us.
So if I'm right, then paperwork is February 17th. Your funding, when somebody has to actually have a check-in, is somewhere like March 15th or something.
Yeah, what happens is they'll get an email. We send out an email saying that we funded. so that you can, you know, say to your clients, hey, we funded, it'll be about 2 weeks before you're going to get everything. Now, the reason it takes about 2 weeks is because now the insurance company's got to issue all those policies for that large group.
Right.
And so it takes them a little bit of time to do that.
Okay.
So I always tell my clients, you know, don't expect to get any paperwork, but it funded today, so you're covered.
Right.
Now you're going to get some paperwork in about 2 weeks that's going to give you who to call, you know, copy of your application, copy of everything. And then they're going to start getting they're going to start getting monthly reminders to make sure that they get their money in. Because again, next year, if they don't have their money in by November, then when the bank goes to look for the second premium and their money's not there, they're going to get kicked out.
Oh, no, I understand.
So we don't want them to get kicked out, and so what we do is we send them about 4 emails saying, hey, get your money in, hey, get your money in, hey, get your money in. And so a lot of them are going to call you and go, I already paid it. How come you keep sending them? Well, we want to make sure nobody misses it, so we keep sending them until the, you know, the deadline date. So they're automatic. 4 going out automatically. I always tell that to a client. Better to have them bug the heck out of you than get kicked out.
Yeah.
And then we can't get the credits and give them statements until after we know what the policy credited. And so it's going to be 2 weeks after the funding date. So they have to have their money in there in November, but they're not actually going to get a statement until 2 weeks after the funding date again, because we're going to get the credits, and then we got to get the, you know, we're going to send out a statement that shows here's what your policy credited, here's what you borrowed at, here's what your everything looks like, and here's you've got 4 payments left, and here's what that looks like on a projected basis, etc.
I got you. But as far as next year, the paperwork's February and the funding is March.
Yeah.
And then finally, I think Edgar told me that through National Life, we would actually not get paid until like the first week of May. Is that about right, or do you have any idea about National Life's process?
I have no idea.
Okay, it's not important. I can find that out from another source. So.
Yeah, I just, you know, our problem is that, you know, we have stuff funding on a daily basis because, you know, we've been in business since 2000. So
yeah.
we have loans funding on a daily basis, and all of our stuff is on spread comp. So I couldn't tell you what checks are coming in to what group on what date.
No, I totally understand. I just was trying to confirm if you knew, but I didn't think you really knew, so just checking.
That's one of your GA questions. All right, have a great weekend, Daryl.
Thank you. You do the same. Appreciate it. This is a really good one.
Oh, thanks. Appreciate it. Okay, I saw another hand. Alan Porter. Alan,
yes.
Are you there?
Yes. Can you hear me okay?
Hey, how are you?
Good.
I can.
All right. I've got a multimillionaire. He's 54 years old, and he's got 2 children, aged 21 and 24. They're in college. Can I do this plan on the children with Allianz? He'll be paying the premium.
Yeah, what you have to do, well, first off, the answer to that question is yes and no. And let me tell you what I mean by yes and no. The requirements for this plan is an executive benefit. So if he's participating at the minimum for himself, he can include his 2 children in the platform as long as he sends in the financial justification for those kids. You have to be able to prove that those kids are going to get, you know, inherit and be worth that $1.5 million death benefit. And I did this for my daughter, so I had to jump through the same hurdles that this guy's asking you to do. I'm doing the plan myself, for one thing, and then I added my daughter to it, and I had to prove that she had enough cash, which she did because she inherited some money. So I had to prove she had enough cash to justify the $1.5 million of coverage. And then because she's in college, I had to prove that I had enough income to pay for both my premium and hers.
Okay. That's
So
not a good plan.
sometimes if they don't have income and they have net worth, we're going to require them to put in all of the contribution up front. So like my daughter's was $13,000 a year. So, you know, if I didn't have income, they would have made me put in all 5 years.
Okay. All right. That's what I need to know.
Okay. Have a great weekend.
Thank you very much.
Okay, let me make sure there's nobody else real quick. We've hung in there this long, so I want to make sure I don't miss anybody. It doesn't look like anybody else's hands raised. So if you want to raise your hand quickly before we disconnect, I don't see anybody else. I think we're good for the day. So I'm gonna thank all of you that have stayed this entire time. It was a very long presentation, and I appreciate it. I hope you have a fantastic weekend. If you guys have any additional questions and you want to contact us directly, you can either send an email through info@kaizenplan.com, or you can call us at the 800 number, and excuse me, that's on the website here. You can find that here. Okay? Have a great weekend. Thank you so much, and we appreciate your time. Good luck.